Hello, everybody. Thank you for joining the quarterly update call. It's always an awesome opportunity to have you guys all here and be able to talk to you directly instead of just posting stuff on the feed. So, firstly, just going to cover quickly what's kind of driving the market at the moment. So, from a macro perspective, there's a couple of big things that's really having the biggest impact on the short term, anyway. So obviously there's still the big Fed policy debate in terms of the bond buying policy, which everybody's expecting to slow down, and that's obviously having an effect on stocks. It's also having an effect on inflation. And as the economy opens up, we've seen effects of inflation already. A lot of talk about whether or not it's transitory, meaning when we go back to kind of more of a normal again, the inflation effects will be over. A lot of other people saying, there's nothing like transitory inflation. Once you have inflation is there to stay. So obviously inflation is a big thing in terms of growth stocks. Our portfolios are very orientated towards growth. But I still think over the longer period, there's no better sector for growth from a portfolio in the stocks that we've got in our portfolio, and we'll go into a bit more detail about that. Something else that's also driving the economy, or driving the market, is obviously the global recovery. We see the US have made a really good recovery in terms of their economy. Everything is back up, except for travel, still lagging, obviously. That probably will open up as well as we see more of the vaccination successfully going through. Some of the other economies also doing really well. Europe was lagging a bit, but it's also starting to pick up. Then obviously the big thing is still COVID, and where we're going from here. Is it going to be a situation where there's going to be new variants and there's going to be more booster shots, and how effective is that going to be? Are we going to see more lockdowns? Is that going to stifle the market again? Or are we going to see more successful vaccination rollouts and more opening of the economy like it's looking at the moment, which is very positive. So you'll see there in the bottom right, if you look at it, that's from our world in data. If you look at the global vaccination rate, we're sitting about 35% of people globally that's been fully vaccinated. So that's not bad. That was quite a bit lower the last time I did this call. So it looks like it's going well. It is slowing down a little bit as well, but I think it's having a good effect on the economy in general. Then we're also starting to see some supply chain issues. So a lot of the companies reporting their results, talking about supply chain constraints, and how they're dealing with that is going to also affect how, in the short term anyway, how that's going to affect their results. And also a little bit of an energy crisis that's starting to brew in terms of prices spiking for natural gas, oil, and we're seeing a shortage of supply for electricity in a couple of regions across the world, and worryingly a little bit so in China. We're seeing some blackouts, not just in the industrial environment, but also in the residential sectors, which is something quite new. Kind of used to something like that happening here where I am in South Africa. We call it load shedding, with the shortage of electricity. That obviously has a big impact on our economy. But yeah, seeing it happen in China, that is worrying, because obviously that will have some ripple effects in terms of supply chain for companies buying from China. Almost, most of the companies, most US companies probably have some sort of import kind of relationship with China. Just to remind you again, I've shared this last time as well, it's maybe a little bit counterintuitive, but when you look at some of these macro events over the course of the portfolio and just the US economy in general, you'll always see these massive macro events, and it always seems scary, and the news and the media will always blow these things out of proportion and make it seem much more worse than it is. The next big stock market crash is always just a week away, as it has been for the last 10 years of this bull run where incredible wealth has been created. But yeah, obviously it is important to be aware of these factors, but people always, if they ask me how does that impact in terms of my investing, very little. And it's not to be arrogant about it. It's just, when you look at quality companies and businesses that we invest in, and if you look at the trajectory of the growth for those companies, where they're going in the next 5 or so years, these kind of effects over time really kind of like smooths out these events, these macro events. It really is about more in terms of the businesses that we invest in. One of the biggest things in the short term obviously does have an effect, and it's been playing out this year to a certain degree in the performance of the portfolio, is interest rates and inflation. When inflation goes up or interest rates goes up, that normally does have a negative impact on, particularly on growth stocks, because it's normally typically growth stocks is valued in the future income, not so much the current revenue. And obviously with interest rates going up, that has a negative effect on that cash flow for the value of that cash and the future income for growth companies. So if you look at that chart, we can see inflation has picked up quite a bit during this year, but it seems like it's started to reach kind of like a peak and starting to level out. But we'll see how that goes throughout the rest of the year, and obviously the impact that will have on the Fed's decision whether or not they raise interest rates. So looking at the performance of the portfolio, we have been lagging this year. Unfortunately, it's obviously not not ideal. It's not something I enjoy seeing. But there's a couple of reasons for this, and it just comes back to long-term investing and where we are and where we came from in last year. So if you look at last year's performance, we had an incredible outperformance of any kind of benchmark, including the NASDAQ. I think we more than doubled the performance of the NASDAQ. And you had funds like, if you guys have been following in the news, there's been a lot of media coverage of like Cathie Wood and the ARK Innovation ETF. I think that was probably one of the best performing mutual funds ETFs out there. Probably like about 130-40%, I think, around about for gains for the year last year. And if you look at this year, it's actually in negative territory. And that is just, again, it's nothing to do with the management of that fund or the stocks, the companies in that portfolio. It's just all to do with valuation, fears of inflation in terms of the growth stocks. Obviously very much growth orientated fund, again, that one as well. So that just brings me back to the performance of our portfolio. I'm not going to try and make any excuses. We are lagging with the benchmark. So a lot of people would say, why don't you just go to something else or look at some other assets or other sectors? And that's by all means, that is not bad advice. In my experience, though, is as soon as you start swapping and chopping and changing, is where, if you're not very careful, is where you can actually really hurt your overall performance over a long-term period. So for me, it's all about selecting the best companies that I see with growth potential over the next 5 years plus, and really sticking to those companies, sticking to those businesses. Like imagine yourself partnering with those businesses and then really investing in those businesses for the long term. So sure, you can rotate out of growth stocks into value stocks and try and time the market into catching some of these cyclical waves. But it really, if you look at all the data and analysis over a really long-term period, there is very few people that can get that right, and you really are better off just sticking to an investment. That doesn't mean you have to just go all in on growth stocks, and we'll have a look at a little bit of diversification a little bit later on. But yeah, if you zoom that out over the last 2 years, then the picture changes a little bit. So that's obviously the portfolio performance again versus the NASDAQ 100. So you can see over a 2-year period, we're still handsomely outperforming that benchmark. And if you can go back even longer, maybe 4 or 5 years, it's even bigger with that cumulative growth over that period outperformance. So I'm still really pleased with the performance of the portfolio this year, even with a lot of volatility and uncertainty. We're still in a good place. A lot of the stocks still doing incredibly well. Some of our top positions in terms of value in the portfolio is still doing incredibly well. We'll also go into that a little bit detail later. We'll see some of the stocks that's been releasing the earnings, showing incredible earnings growth, but the share price has taken a little bit of a dive. And that for me is always a really good sign, really good opportunity to reinvest back into those companies. So just if you look at that long-term view again, and I always encourage this, if you look at that fact sheet, the link is on my page. You can, the eToro fact sheet. it shows you that more of a long-term view. So if you look at that total return, 315% versus the S&P 500's 107%, or looking at it another way, 31% annualized return. Last year you can see that 84% return, and that's really why we're seeing a more muted performance this year for funds like at ARK Innovation ETF and like a portfolio like ours. Is really just because of that massive pull forward that we had last year because of the pandemic and everything, that remote work and everything, that basically everything digital just got a huge boost. But that's not to say it's not going to continue growing in the future. It's just to say that, you know, when you see things like inflation and reopening of the economy, you see these cyclical moves between growth stocks back into value stocks. But I'm still 100% convinced that over the next 5 years or so, you know, the biggest growth will come from, you know, technology oriented and growth stocks. If you look at it another way, so that just shows you another picture of that. So these are the top 10 holdings on our portfolio. And if you look at the performance versus 2020 versus 2021, you can kind of see that massive pull forward that I'm talking about from 2020. If you look at some of those returns, it was incredible returns for Shopify, like 184% in 2020. Tesla obviously went ballistic. And then you've got a company like the Trade Desk, is exactly an example like I was mentioning earlier. So it had huge pull forward in 2020, and this year it's down by 11%. So if you look at the latest earnings call from the Trade Desk, it actually, I think, well, I've got a slide on that, but it actually grew revenue by over 100% versus over year-on-year basis. And it's a, you know, the Trade Desk is one of those companies where having a comparison between 2021 and 2020 is a very good comparison, because 2020 was already a very good year for the Trade Desk. So for the Trade Desk to actually increase revenue by 100% from an already outstanding year is incredible. And it's because they're in one of those incredibly growth sectors and programmatic advertising. And the share price has just dropped. So for me, that company is still doing incredibly well. And that's typically one of those things where you'll see eventually the share price will just catch up again with the performance of the actual real performance of the company. So looking at just again, if you look at all of the stocks in the portfolio, the top performing stocks on the left and then the worst performing stocks on the right, you'll see the Trade Desk there down 11%, but we've also got some companies doing not looking so good on that slide, like Fastly down 50%. Luckily, our exposure is not, you know, equal weighted over all these companies. So if you look at it another way, if you just look at the top 20 stocks in the portfolio, you can see a lot of the top stocks in the portfolio have done really well. Like Nvidia still grew by 58% this year. It's our top holding. We've got companies like Google, Zscaler, Microsoft, Shopify, some of the top holdings in the portfolio doing really well in this year. But some of the companies obviously lagging, that's hurting the performance this year, like the Trade Desk, Disney, Roku. Those are also companies we've got a rather large position in that's not performing so well. But every one of those companies on the right-hand side is incredible investments, incredibly well-run businesses with incredible products that will continue to do well. So I always like to just show this slide as well. When you look at, you know, that slide where we look at the company like Fastly that's down 50%, you know, a lot of questions will be asked, like why are you hanging on to a company like that? And it really comes down to that partnering with a business over the long term. You know, some of these companies, it takes a while for them to execute on the plan. It doesn't happen on a quarter-to-quarter basis when they report their earnings. It happens over 2, 3, 4, 5 years to execute on that strategy. Fastly, I think, is one of those companies that's got superior technology, it's got superior ownership and management, and it's got a lot of growth potential ahead of it. It's lost 50% of its value this year. Luckily, we've got a diversified approach in terms of the 50 plus holdings in the portfolio. But yeah, if you look at something like Netflix as an example, when it listed in 2002, if you had bought shares for $1,000, you'd be sitting on roughly $580,000 today. But that's a long-term holding, being able to get there. So what I always like to do is put this in context. If you look at the journey of that growth stock over that time, if you look at that chart, it looks great. It looks like an awesome story. If you look at the drawdown chart, so what this does is shows you the amount of times and the percentage that stock was off its all-time high. So in that same period, that's the same chart, that's the same data, just looking at it from a drawdown perspective, it looks a lot more chaotic. So in that period of time, if you had to hold on for that period of time, you would have had to endure losing 80% of your investment in Netflix in that time. Twice you would have lost 70%, and 5 times you would have lost 30 to 60% of your investment. So if you look at that first little period there between 2012 and 2013, your investment would have grown to $34,000 and then subsequently went all the way down to $7,000. Or put another way, you've lost 27 times your original investment of $1,000. So just it's interesting just to put things into a different perspective, and it really is this: if you find the right companies and you can partner with them and you can invest in them on a long term, you really will be rewarded over long term. Not all of them will obviously always work out, and that's why we have the basket approach, but if you look at a company like Netflix, that multi-bagger performance way far offsets the 50% that you lose on some of the companies. So if you've got a basket of 50 companies, even if you just have a couple of these winners like Netflix that change the game, you are going to far outweigh the couple of losers, because these companies go on to grow by 5,000, 10,000%. It far outweighs the companies, the couple of losers that you inevitably will have, losing 20, 30, 40% of their value. So just a word on diversification and where we are in terms of the portfolio. So this is the current weighting, what it looks like. So you can see the biggest holdings there: Nvidia, Shopify, Tesla, Trade Desk, Roku, Twilio. You'll also see that cash position there. So a lot of people also ask the question about why are those funds not being invested. Early in the year, when we did go through a little bit of a dip again, we added some funds to the portfolio, trying to limit that as much as possible, because it does cause some sinking issues and all that. So try not to do that unless there's a severe downturn in the market, which I always believe is a great opportunity to add some money back into the portfolio. But in general terms, that's where we stand, and the cash position is there for a reason. It's really, it plays an important part. You can almost see it as part of the portfolio. It's not being used. It's one of the assets in the portfolio, and we use it to buffer some of the volatility, and we use it so that we're able to, when the opportunity is there, to quickly buy either existing holdings if there's a good opportunity to buy back into those stocks, or opening up new positions in new companies. So there is a lot of talk about diversification. There are always worries in the market in terms of growth versus value. Especially this year, we've seen like the more cyclical stocks like energy stocks and things like that coming back up. Interestingly enough, I think this year is the first year in a couple of years where the S&P 500, typical index is weighted by market cap. So the biggest companies in that index would be companies like the technology companies, Microsoft, Google, Amazon. But if you look at the weighted index, which doesn't look by market cap, that's actually outperformed the S&P 500 weighted index. So that means like a lot of the not so popular stocks, the value stocks, if you want to call them that, have really done well this year. So in terms of diversification, if you look at our portfolio, obviously it's very much geared towards growth, because like I said before, I think we've got a year like this year, but you've got an incredible year like last year of outperformance, and the year before that, and I still believe the next couple of years we'll see a lot of these growth companies doing really well. But that's how we stand in terms of the allocation, in terms of stocks versus cash versus ETF. So I recently added an ETF that tracks the value stocks, just to give us a little bit of that diversification into more value oriented, because the portfolio is so heavily geared towards growth. But obviously, from a personal individual investor perspective, you know, your individual situation, everybody individual situation obviously varies. You know, for me, I look at it, you know, you've got to look at your time horizon and your risk tolerance. The portfolio theory and things like that will tell you, you know, you've got to look at, you know, how many years do you have left to retirement? So I'm not going to get into all that, but, you know, I always just say, you know, this portfolio, this is my portfolio. So right, this is my largest part of my wealth is in this portfolio. Obviously, I do own some property and some other things not inside of eToro, but in terms of my stock investing portfolio, this is it, because this is where I believe the main growth will come. I think, you know, for me, I've still got hopefully a good 20 years plus left before retirement, so I can take some risk and I can ride out some of that market volatility and cycles. And like I said, I firmly believe over that period, this kind of allocation in terms of growth stocks will be the best returning place to put my funds. But that's not for everybody. So I just like to show this. So, you know, for some people, if you look at that 20 plus time horizon and your risk tolerance is quite high, this is kind of like, you know, the default portfolio in terms of stocks or equities versus bonds and cash. But if you look at the other side, you know, if you've got less time left and you only want to invest for like a couple of years, then equities is maybe not the best place to put your money. So that's why I always caution to say, you know, investing in stocks in general is long-term, and it should be a long-term investing endeavor, and especially investing in growth stocks. Here you can see that looks completely different for somebody that's much more cautious and has got a much lower, smaller time frame for investing, and much more exposure to bonds and cash and ETFs versus equities or stocks. And obviously within that stock portion, you can also diversify and look at different asset allocations, like do you go small cap, large cap, do you go value, growth, that kind of thing. In terms of our portfolio, you know, like I said, this is for me where I see the best value, return, and investment over those companies. Those companies that are making up the biggest portions of our portfolio are the big cap stocks. So a lot of the big companies like the Shopify's, like the Nvidia's, those are big holdings, big successful companies that's got lower, smaller volatility in terms of their risk towards the rest of the market. Obviously, they're still exposed to risk. They are still growth-oriented companies. Then a smaller percentage of that will be into the smaller cap or mid-cap stocks, where we only have a small position, but those are the positions I see that can grow over time. That could be the next Trade Desk or the next Roku, and we're starting off small. And then obviously the really small positions that, you know, just to get some skin in the game and start following those companies a little bit more. And then obviously we have our cash position that helps with that volatility and enables us to make some quick buys as well. Okay, so just some forecasts and outlook in terms of where we are, where we're going. So earnings season is about to start again. I think Netflix reports starts off the tech earnings season on the 19th. And then we're going to have a very busy period again where all these companies start reporting their fourth, or depending where they are, their financial years, their quarterly earnings. If we look at the previous earnings season, 47 of the 51 companies at the time beat earnings in the portfolio. So all of the companies really reported really strong numbers. What you saw though is, even though they reported really strong numbers, in a lot of the cases the stock prices actually took a hit. And a lot of that was due to not so much the earnings results, but more in terms of guidance. So when the companies report their earnings, they also give their guidance and where they see the next quarter or the full financial year. And a lot of these companies were just saying, you know, look, we had an incredible run, but things are changing a little bit. So they're kind of doing the same thing, I suppose, to a certain extent that I'm doing. You know, you kind of like just temper the investors in those companies in terms of the growth expectation. You know, because you had that pull forward because of 2020, what happened, you're not going to maybe see that again this year. You're still going to see awesome numbers, and they showed it, but it's just to manage that expectation. Because of that managing that expectation in terms of the guidance, investors don't like that. They want to keep seeing that huge growth they saw in 2020, and then they sell and they move on to something else. That's the short-term kind of view on Wall Street, and you see that big funds obviously creates a movement in the markets where they sell out of certain stocks and they move into something else. But yeah, if you look at the portfolio, our portfolio, incredible numbers, incredible results. And like I said before, if you look at maybe this next slide will show it. These are the top 5 positions in our portfolio and the numbers they reported. So if you look at NVIDIA, reported revenue in the previous quarter of 6.51 billion, that grew 68%. So for a company that's already producing revenue of 6.5 billion, for it to grow by 68% on a year-on-year basis is absolutely incredible. Same with Shopify. Shopify also, you're comparing Shopify results to 2020 when e-commerce was booming. It was Shopify had one of its the best year in the company's results during last year. And even so, even though a lot of people were saying like that's going to go away suddenly, it's not going to go away. You know, things have changed. It was already changing before 2020, just accelerated. Shopify running that, you know, that e-commerce platform grew their revenue by 56% compared to an already incredible year in 2020. Tesla, you saw the share price, I'm sure, of what Tesla has been doing, and it's held really strong even this year, even though it had that incredible 700% growth in 2020. It's still done really well this year, and because they're actually reporting really good numbers. 98% revenue growth year on year, and we'll actually look at the actual deliveries on the vehicles. Trade Desk, there you can see it, 100% revenue growth, and the company's stock price is down 11%. Right, so last year, you know, everybody was going crazy, buying Trade Desk, shooting up the stock price. This year, the company actually reports better earnings than ever before, and the stock price takes a hit. That for me is an opportunity. And the same with Roku and Twilio reporting. So those numbers are not share price movements, that's actual revenue growth of these companies. If you look at the themes in the portfolio, there's quite a few holdings in the portfolio. I always look at it like this, themes or the buckets. So if I look at some of these themes, a lot of them I know a lot about, and I work with them on quite a bit. Some of them I'm not going to be an expert in, things like biotech stocks. So I've got like a little biotech basket of 7 or 8 stocks. I want to get a little bit of exposure in that. And then there's going to be some winners and some losers in there. But that's the way I like to approach it. So from a diversification perspective again, that gives me that exposure into that health tech space, but without, you know, having to be an expert on it. Doing the research and seeing which of the companies in that space I see has got the strongest moat or the strongest IP, developing things like, especially in the CRISPR kind of environment. But yeah, some of them will go on to probably be incredible investments. Some of them might not work out, but again, the winners, they will probably more than outweigh the losers. But yeah, in general terms, this is the way I split up the portfolio into those different themes. So another big theme for me coming up, and you'll probably hear a lot more of this, people talking about this, is this concept of the Metaverse. So if you've seen the movie Ready Player One, it probably won't look like that for quite some number of years, but we are seeing the kind of the grassroots of this starting to play out. Facebook going big on this idea of the Metaverse, basically just creating this third place where people will go to. It's already happening in gaming, where people doing online in-game transactions that's shot up hugely versus, you know, just buying the game. But it's going to be all this connected third places, not just in gaming, but via augmented reality, connecting in a different way in e-commerce and everything in this virtual space. So companies going big into this and will probably benefit a lot with this theme coming up is companies like Facebook and Microsoft creating the apps, creating the backbone for this, but then also companies in the portfolio like Adobe and Unity Software that creates the content for this. One of the biggest stocks that's probably going to benefit from this is a company like Nvidia. It's got built an actual platform specifically for this called the Omniverse platform. And it's a company like Nvidia, and this is what I always look at for some of the companies in the portfolio, is where some of these themes kind of interconnect. I just pulled some stats from from a report from ARK Invest, the Big Ideas 2021 report. So if you look at that breakdown of global revenue in gaming versus just in-game purchases versus just from buying the game, so there you can see that's growing substantially. And then on the right hand side, just where they see the opportunity going for augmented reality. And again, if you look at a company like Nvidia, it's really at the crossroads of all these themes playing out. Artificial intelligence is probably the biggest play on artificial intelligence in terms of the chips that they produce that's running that AI workloads in the cloud data centers for Microsoft and Amazon running on those Nvidia cards. Autonomous vehicles, they've got their own platform for that. Augmented reality, cloud and data center. As we go more into cloud, Nvidia is going to play a bigger role. Gaming and crypto, they're already playing a big role in that. And obviously in the semiconductor space, like everything is just chips, right? That's why there's such a big shortage of that right now. Again, from ARK, if you look at where they see this total chip market going in terms of artificial intelligence and deep learning chips, Nvidia stands right at the middle of benefiting from that growth. And even on the data center, just purely on the data center server space, Nvidia is now part of in a big deal to acquire ARM Holdings. So if you look at where ARK sees the ARM architecture replacing that traditional x86 server architecture, that's going to be another big, huge driver tailwind for Nvidia if it goes through. There's a competition commission. Obviously, the EU is looking at that, and they're making a decision shortly, I think at the end of this month. So we'll see how that goes. But besides that, Nvidia really standing at a crossroads of a lot of these big technology themes playing out. And that's what I really look for in some of these stocks. Nvidia really being a key one for me, but there's a lot of these other companies like the Trade Desk and Roku playing in that programmatic advertising space. Just a couple of other short things, like I mentioned, Nvidia is acquiring ARM. Facebook just recently, they had a technical outage, and there is some not such a good reputational thing going on with social responsibility. But Facebook just showed us again in terms of that outage how much people rely on things like WhatsApp and Instagram. And if you look at where they are in monetizing those things, they're nowhere near even starting to monetize something like WhatsApp. That's such a big thing for a lot of people. So there's still a lot of growth there. And that's really, for me, a lot of these companies, we saw some of those smaller cap stocks that still got huge growth potential ahead of them, but there's a lot of uncertainty as well. Then a lot of more of the bigger companies like these that have already seen huge amounts of growth. A lot of people might think the growth story is over, but there's a lot of growth still in these companies. Like a company like Netflix, absolutely dominating the streaming environment, which is still just going to grow. If you look at some of the results, they own some of the biggest IP in terms of the top streaming, most viewed content. Tesla, we mentioned that earlier, delivered 241,000 vehicles. That's up 73% year over year. So justifying that incredible stock price increase that we've seen. Obviously, it's not just about the vehicles. Tesla is much more than that, and playing into that renewable energy sector as well. And then Fiverr, also another company that has taken a bit of a hit this year. They've just made an acquisition, Creative Labs, for training up some of that freelance workers. It's now the second biggest company in terms of that gig marketplace of freelance work, which we see that trend is probably going to continue as we move forward in terms of a lot more people working on these type of freelance marketplaces. And Fiverr is the second biggest one next to Upwork, and it is growing revenue a lot faster with much better margins than Upwork. So even though the stock price again has taken a bit of a hit, there's still a lot of growth coming from that company, and the share price is bound to catch up again. So yeah, that's it for me. Just like to end it off with this. So obviously, just in general terms, we don't use leverage. All the gains is achieved with not risking any leverage, any fees in terms of leverage. We always keep some cash. And yeah, just some of the key concepts for me is about, it's really all about patience. We don't trade ticker symbols, we really invest in these companies. We don't try and predict the short term, but we can, with some certain degree of confidence, know where many of these companies will go in the next 5+ years. So I want to thank you for joining this call, and if you're a new copier, thank you so much. I know it might have been frustrating this year. It has been a bit of an up and down year. If you're a long-term copier, thank you so much for sticking with it and being with me for such a long time. And I've seen in the stats there's a couple of copiers that's been copying me for quite some years. And thank you for staying with me, and thank you for joining the course.